G'day. I had a client ask a question the other day and they wanted to know what my preferred investment structure was. Is it managed funds or ETFs, or is it going directly? And it was an excellent question, and one that I've spent a lot of my career really shaping the type of advice we provide because of some of the downfalls when you are using products. So products such as managed funds and ETFs, there's similarities there between them. Managed funds can be sometimes an expensive product, as can ETFs as well. But where I've probably made big changes in the way that I invest personally and the way that I have for my clients has been that we've gone as direct as possible. And some of the reasons for that, and this is going back all the way to 2003, where I did my first margin loan in March of 2003, right at the start of March, just before the second Iraq war started. So within a week, I probably got lucky and I picked the bottom of the market. And I took a margin loan out and put $80,000 into the market, which was a massive amount of money for me at the time. Held the investment all the way through for quite some time, but from March to the end of June, during that financial year, the managed fund had been churning over, buying and selling, and I copped a pretty significant tax bill because there was all these unrealized capital gains that were there many years prior that I bought in for the last 3 to 4 months of that financial year, and I copped all these unrealized capital gains, which affected my tax outcome. So in addition to fees, you have no control, or the fund manager is really not thinking about people's tax outcomes. So if you buy into a managed fund, you are going to inherit someone else's, I suppose, unrealized tax liabilities. So my preference, as much as possible, is to go direct as possible. But it doesn't always suit people. A self-managed super fund, where the majority of people's wealth is that we advise on, is within superannuation. So where we can use managed accounts and it's within super, it doesn't really matter. We can use managed accounts, ETFs, and also managed funds in those areas, and tax is not going to be a problem. We also like to have control. I love to know where money's invested. So going directly is important, but also if you choose ETFs or managed funds, the see-through now, the disclosure that these companies have to provide is really, really good. So you can go in and see exactly where your money's invested within an ETF. So if you're buying an American-based, the S&P 500 ETF through Vanguard, you can get reports and see exactly where the majority of the money is invested. So there is disclosure there and transparency, which is something that I really value. But my preferred option, I love to go direct. If I think Microsoft and Google and Visa are amazing businesses, which I do, I want to own them directly as possible. And there's areas where you may want to avoid, and you don't get that. Choose to say, we do have a preference not to invest into resources. That's our preference, and that is all backed up by a lot of research. I want to make sure I'm not in those spaces, so going direct allows me to do that. Thank you for listening. If you've got any questions, please ask us, or any comments. We're happy to cover off any topic you've got on your mind. Cheers, bye.